On July 28th and 29th, 19 policymakers will sit around a very large table in Washington and discuss the price of money. 12 will vote. One of them, Kevin Warsh, will lead the meeting for only the second time as chairman of the Federal Reserve. There will be charts, forecasts, regional reports, market data, and probably enough coffee to qualify as a minor fiscal program. At the end, the Federal Open Market Committee will decide whether to keep its benchmark interest rate range at 3.5 to 3.75%, or raise it for the first time under its new chairman. That decision will not directly set your mortgage rate, the yield on a 10-year Treasury bond, the price of a stock, or the value of the dollar, but it can influence all of them. The Fed can change financial conditions across the planet without passing a law, winning an election, or even leaving the building. And this meeting arrives at an unusually awkward moment. Inflation remains above the Fed's 2% objective. The labor market is slowing, but it has not collapsed. Business investment, especially around artificial intelligence and data centers, remains strong. Housing is weak, oil prices are volatile. Federal debt is approaching $40 trillion, and a new chairman is trying to prove that he is independent from the president who appointed him. So the obvious question is, will Kevin Warsh raise interest rates? But the better question is, what kind of Federal Reserve he is trying to build, what he inherited from Jerome Powell, and how monetary policy now interacts with government borrowing, tariffs, markets, and an economy that refuses to behave like the models. The Federal Reserve does not control the economy. It controls a few powerful tools, influences expectations, and hopes the economy receives the message. Sometimes it does. Sometimes it reads the message 6 months late and replies during a recession. The Federal Reserve was created in 1913 after repeated banking panics convinced the United States that allowing the financial system to improvise its way through every crisis was not a sustainable national strategy. Today, the Fed supervises banks, supports the payment system, acts as a lender of last resort, and conducts monetary policy. The main monetary policy body is the Federal Open Market Committee, or FOMC. It includes the 7 members of the Board of Governors, the president of the Federal Reserve Bank of New York, and 4 other Reserve Bank presidents who rotate as voters. The remaining presidents still attend and participate. So when people say the Fed decided, they're simplifying a committee full of economists, lawyers, bankers, regional perspectives, and several people who believe their spreadsheet is the calmest person in the room. The committee has 2 central goals: stable prices and maximum employment. Stable prices does not mean prices never rise. The Fed defines price stability as inflation of about 2% over the longer run, measured primarily by the Personal Consumption Expenditures Price Index. Maximum employment is not one fixed unemployment number. It is the strongest labor market the economy can sustain without destabilizing inflation. The Fed's primary lever is the target range for the federal funds rate, the overnight rate at which banks lend reserve balances to one another. In the modern ample reserve system, the Fed helps keep market rates inside that range, mainly by changing the interest it pays banks on reserve balances and by using other money market tools. Nobody cancels dinner plans after checking the overnight reserve market, but short-term rates form the foundation for a much larger structure. When the Fed tightens, bank funding costs tend to rise, Treasury yields can move, corporate borrowing becomes more expensive. The dollar may strengthen, stock valuations can fall, and mortgages, auto loans, and credit card rates often become more painful. Economists call this the monetary policy transmission mechanism. Consumers call it, why did financing this car become a character-building exercise? The Fed also influences conditions through its balance sheet. Buying Treasury or mortgage-backed securities can push down longer-term yields and support market functioning. Allowing those holdings to decline can make policy less accommodative. This became especially important after 2008, and during the pandemic when short-term rates were already near zero. But policy works with long and unpredictable delays. Markets can react immediately, housing within months, business investment later, and employment and inflation. Central bankers must therefore make decisions using incomplete data about a future economy. The Fed also cannot produce oil, build houses, reopen a shipping lane, train nurses, or remove a tariff. What it can do is prevent a shock in oil, food, or imports from spreading into wages, services, expectations, and a broader inflation process. That is the real issue in July. Not whether 1 month of prices looked good, but whether inflation pressure is becoming persistent enough to require tighter financial conditions. The current inflation story begins with the pandemic. In early 2020, large parts of the economy simply stopped. More than 20 million American jobs disappeared in weeks. Companies rushed for cash, and even the Treasury market showed severe stress. the Fed cut rates to nearly zero, purchased enormous quantities of Treasury and mortgage securities, and created emergency lending facilities. Congress and the White House added massive fiscal support through direct payments, expanded unemployment benefits, loans, and grants. Those actions prevented a public health disaster from becoming an even deeper financial depression. But the recovery created a new imbalance. Household demand returned faster than global supply. Consumers had money. Factories had disruptions. Ports had congestion. Labor markets had shortages. And housing supply was nowhere near ready. Too much demand met too little productive capacity. At first, the Fed described much of the inflation as transitory. That was not an absurd idea used. Car prices, shipping costs, and bottlenecks really could reverse. The mistake was underestimating how broadly inflation would spread and how persistent demand would remain. By the time the Fed began raising rates in 2022, inflation had moved far beyond a few pandemic categories. The tightening that followed was one of the fastest in modern Fed history. The policy rate reached its highest range in more than 2 decades. Growth slowed, housing suffered, and borrowing costs surged. Yet the economy avoided the immediate deep recession many forecasters expected. Supply chains normalized, the workforce expanded, productivity strengthened, and inflation declined from its peak. That should have been the clean ending economics, however, dislikes clean endings. The latest consumer price report showed headline CPI up 3.5% over the year, while core CPI was up 2.6%. Core prices were flat in June, which is encouraging, but the Fed's preferred PCE measure was less friendly in May. Headline PCE inflation was 4.1%, and core PCE was 3.4%. CPI and PCE use different weights and methods, and the Fed officially targets PCE1 soft CPI report does not erase several years of above. Target inflation, particularly when energy prices, tariffs, and services costs remain potential sources of renewed pressure. The labor market also sends mixed signals. June payroll growth was only 57,000, while unemployment held at 4.2%. That is not a collapse. It is a labor market that has cooled substantially without widespread layoffs. Hiring is weaker, but unemployment remains low by historical standards. Growth is uneven as well. First quarter real GDP expanded at an annualized rate of roughly 2.1%. Housing remains constrained by expensive mortgages. At the same time, business investment is being supported by enormous spending on data centers, semiconductors, power infrastructure, and AI-related equipment. This leaves the Fed with slower hiring, weak housing, resilient demand, strong technology investment, and inflation that is improving in some measures while remaining too high in others. It is not classic 1970s stagflation, and it is not a clean, soft landing. It is an economy with one foot on the brake, one foot near the accelerator, and several $100 billion of data center construction in the back seat. To understand Warsh, we need to understand the chairman he replaced. Jerome Powell led the Fed from February 2018 until May 2026. He was chosen by Donald Trump, later renominated by Joe Biden, and survived 8 years in a position where every decision disappoints someone with a television camera. Powell was not a traditional academic central banker. He trained as a lawyer and spent much of his career in finance and government. His great institutional skill was consensus. He listened, built broad agreement, and usually presented policy as the committee's collective judgment rather than the chairman's personal doctrine. His style was cautious, pragmatic, and dependent on incoming data. That helped him adjust when facts changed. But it also created a recurring criticism. Waiting for confirmation can mean waiting until the problem is already expensive. His first major test came in 2018 and 2019. The Fed continued raising rates as the economy expanded, then shifted toward cuts as financial conditions tightened and global growth weakened. The episode showed Powell's willingness to pivot and taught markets to watch for the point at which stress might change the Fed's direction. Then came March 2020. Powell's Fed moved aggressively, cutting rates to nearly zero and launching programs to prevent markets and credit channels from freezing. Whatever later criticism Powell received, the emergency response was decisive. The harder chapter came during the recovery. The Fed kept rates near zero and continued large asset purchases while inflation accelerated in 2021. Officials initially believed supply problems would fade. Some did, inflation did not. The word transitory became a historical artifact and a convenient object for congressional hearings. Powell eventually changed course. In 2022, the Fed began an aggressive hiking cycle at Jackson Hole. That August, Powell warned that restoring price stability would bring pain to households and businesses. It was the central banking equivalent of canceling the party and reading the fire code aloud. His defenders argue that the Fed faced an unprecedented pandemic, unreliable data, supply shocks, and fiscal stimulus. His critics argue that it waited too long and maintained emergency policy after the emergency had changed form. Both arguments contain truth. Powell's Fed was highly effective at stopping a financial collapse and late at recognizing the inflation regime that followed. It then tightened without producing the unemployment surge many expected. Powell also expanded Fed communication through frequent press conferences, forward guidance, economic projections, and the dot plot. The goal was to reduce surprises. The risk was that markets became dependent on guidance. Investors listened to the Fed, while the Fed looked to market prices for information. It became a financial hall of mirrors, except everyone wore a suit and called it price discovery. By the end of Powell's chairmanship, rates had fallen from their post-pandemic peak, but inflation remained above 2%. He left Warsh a resilient labor market, a large balance sheet, a communication system built around transparency, and an unfinished debate over whether the central bank had become too large and too predictable. Monetary policy is only one side of American economic power. Fiscal policy belongs to Congress and the president. They decide taxes and spending. The Treasury Department finances the difference by issuing bills, notes, and bonds. The Fed does not decide the federal budget, and the Treasury does not set the federal funds rate. The Fed can buy Treasury securities in the market as part of monetary policy, but it does not give the government a magical checking account. Sadly for elected officials, even central banking has accounting. The United States now has roughly $39.5 trillion in total federal debt. The danger is not that every dollar must be repaid tomorrow, like the most upsetting mortgage statement in history. Treasury debt is continuously issued, refinanced, and held by domestic investors, banks, pensions, the Fed, and global institutions. The more immediate issue is interest cost. As older, low-rate debt matures and is replaced by higher-yielding debt, federal interest expense rises. Treasury data show the cost of servicing the debt above $1 trillion, close to one-fifth of federal spending in the current fiscal year. That does not make a debt crisis inevitable. The United States issues the leading reserve currency and operates the deepest sovereign bond market. But interest payments consume fiscal space that could otherwise fund defense, infrastructure, healthcare, tax relief, or Washington's traditional priority of arguing about all four. This creates political pressure for lower rates. Presidents like cheap credit because it can support housing, investment, markets, and growth. Lower rates may also reduce government financing costs over time. Although Treasury yields depend on the entire yield curve, inflation expectations, growth, issuance, and investor confidence. Donald Trump has never hidden his preference for lower rates. During Powell's first term, he criticized the Fed repeatedly despite appointing Powell himself. The conflict raised a deeper question: should monetary policy serve the short-term needs of an elected government or remain insulated enough to make unpopular decisions? History shaped the modern answer. During World War II and its aftermath, the Fed held down Treasury yields to help finance the government. During arrangement untenable, the 1951 Treasury Fed Accord independence does not place the Fed outside democracy. Congress created it and defines its mandate. The president nominates governors and the chair. Subject to Senate confirmation, independence means policymakers are expected to set rates according to that mandate, not according to the next election. Warsh has inherited this tension directly. Trump appointed him, and the administration would benefit from lower borrowing costs. But Warsh has emphasized that monetary policy must remain independent. He also meets regularly with Treasury Secretary Scott Bessent, following a long institutional tradition. Coordination and independence can coexist. The Fed must understand fiscal policy, debt issuance, tariffs, and global events. If the Fed is restraining demand while the government runs large deficits or imposes tariffs that raise costs, the central bank may need tighter conditions. One institution steps on the brake while another adds weight to the vehicle and asks why fuel efficiency has declined. That is why debt, Treasury issuance, tariffs, and Fed policy meet in the bond market. If investors demand higher yields because of inflation, heavy issuance, or uncertainty, mortgage and corporate rates can remain high even if the Fed cuts. The chairman controls an important overnight rate. He does not personally own the yield curve. Kevin Warsh is not new to the Federal Reserve. He served as a governor from 2006 to 2011, placing him inside the institution during the global financial crisis. Before that, he worked at Morgan Stanley and in the George W. Bush White House. Later, he joined Stanford's Hoover Institution, taught at Stanford's Business School, and worked with the Duquesne Family Office. That background matters because Warsh approaches the Fed differently from a career academic economist. He emphasizes institutions, market signals, the balance sheet, productivity, and the risk that central banks become too confident in models that cannot capture structural change. His first FOMC meeting as chairman, in June, produced no rate change. The committee voted unanimously to keep the target range at 3.5 to 3.75%. But the presentation changed immediately. The policy statement became shorter. Forward guidance language disappeared. Warsh declined to submit. He announced reviews of Fed communication, the balance sheet, economic data, productivity, and employment, and the inflation framework. Powell's Fed tried to reduce uncertainty by explaining the likely path of policy. Warsh appears more interested in preserving some uncertainty, so markets continue forming independent judgments if the Fed tells investors exactly what to expect. Market prices may merely echo the Fed's own forecast back to it. There is logic in that view. There is also risk. Less guidance can make markets more informative, but it can also make them more volatile. A central bank can stop holding the market's hand, but it should not be surprised when the market starts running through the parking lot. Warsh has placed price stability at the center of his early message. He argues that persistent inflation is largely a monetary policy responsibility, and says the committee will restore 2% inflation. Still, he should not be reduced to a man who wants higher rates forever. He has also emphasized productivity and the possibility that stronger supply-side growth could allow faster expansion without as much inflation. That suggests a possible doctrine: a leaner balance sheet, less forward guidance, more reliance on market prices, skepticism toward conventional forecasts, and firmer accountability for inflation, combined with openness to lower rates if productivity genuinely expands capacity. The problem is timing. AI investment may raise future supply, but data center construction, electricity demand, specialized labor, and semiconductor spending can raise present demand. Technology has once again arrived carrying both a solution and an invoice. Warsh's first meeting told us more about his operating style than his exact rate preference. He values optionality, dislikes pre-commitment, and appears willing to make markets work harder to understand him. Which brings us back to July. There are 3 plausible outcomes, but they are not equally likely. Inflation remains above target on the Fed's preferred measure. The labor market has not deteriorated enough to demand emergency support, and Warsh has spent his first weeks emphasizing price stability. A cut would contradict nearly everything the new chairman has said and invite accusations that he surrendered to political pressure before his nameplate was fully settled on the desk. A rate hike is more plausible. PCE inflation remains high. The labor market is stable. AI-related investment is strong. Tariffs may raise prices, and energy shocks could spread. The June projections also showed a meaningful group of policymakers expecting a higher rate by year end. A hike would establish Warsh's credibility quickly. Raising rates at his second meeting would tell markets, the White House, and the public that his price stability language was not decorative. But my base case is still a hold. The latest CPI report provided evidence that underlying inflation may be cooling. Payroll growth has weakened. Housing remains under pressure. The July meeting has no new summary of economic projections, and crucial reports on second quarter GDP and June PCE inflation are scheduled for the morning after the decision. Hiking immediately before those releases would require unusually strong conviction. Market pricing reflects that uncertainty. As of this recording, investors still favor no change, though a quarter-point hike remains a serious minority outcome. A Reuters poll of economists also mostly expects a hold. So the most likely result is this. The committee keeps the target range at 3.5 to 3.75%. But the statement and press conference sound more hawkish than the decision itself. Warsh will likely emphasize that one soft inflation report does not establish a trend, that the 2% objective is not negotiable, and that the committee is prepared to act if inflation remains persistent. There may also be dissent. A split vote would matter because the June decision was unanimous. It would show that the internal debate has moved from whether policy is restrictive enough to how soon the Fed should tighten again. The biggest market reaction may come not from the decision, but from Warsh's language about September. Because he has rejected traditional forward guidance, investors should not expect a neat promise. They will study every phrase, pause, and adjective. Because financial markets can turn one adverb into several $1 billion of positioning. If the Fed holds and Warsh remains hawkish, short-term Treasury yields could stay elevated and rate-sensitive assets may face pressure. If he sounds patient, yields could fall and stocks could rally. But markets respond not only to what the Fed does, but to the gap between the result and expectations. A widely anticipated hike can move prices less than a hold, accompanied by unexpectedly aggressive language. Finance is one of the few fields where the event can matter less than the argument investors had with an imaginary version of it beforehand. The July meeting is therefore about more than 25 basis points. It is the second test of a new chairman, the first serious test of his anti-guidance strategy, and an early signal of how he will handle inflation, political pressure, fiscal deficits, energy shocks, and technological optimism. Powell's great challenge was moving from emergency support to inflation control. Warsh must finish that fight without crushing housing and employment, remain independent without becoming politically isolated, reform communication without creating chaos, and recognize real productivity growth without mistaking an investment boom for a free lunch. The committee is deciding where to set an overnight interest rate. Beneath that is a larger argument about trust. Whether households trust that prices will stabilize, whether investors trust Treasury debt, whether markets trust the Fed's communication, and whether the Fed trusts its own models enough to act before certainty arrives. My prediction is a hold, with the door left visibly open to a later hike. More broadly, the Warsh Fed is likely to be less predictable, more skeptical of forward guidance, more aggressive in reviewing its own machinery, and more willing to make price stability the test of its credibility. That may create uncomfortable markets. It may also produce better information. On July 29th, the most powerful economic committee in the world will release a statement of only a few paragraphs. For the next several hours, millions of investors will try to determine whether every missing word was intentional. Knowing the Federal Reserve, it probably was.